In this video, we'll examine a real trade example using the IWM ETF to understand how put options work and why they can be valuable even when the stock price is higher than the strike price. Get ready to unlock the power of put options and discover the leverage they offer in your trading journey. Oh, and one more thing. Be sure to like and subscribe our channel. Okay, now let's dive in. Hey there, we're moving on to the second type of option known as the put option. Everything we talked about so far has been about call options and buying them and how that works. As I mentioned before, the second type of option is called the put option. If you understand how call options work in the previous section, you'll pick up put options just as easily because the concepts are the same but flipped around. With put options, their prices go up as the stock price goes down and vice versa. This is because put options gives the buyer the right to sell 100 shares of stock at the put option strike price between now and expiration. While call options let you buy 100 shares of stock at the call option strike price, put options let you sell 100 shares of stock at the put option strike price. This means that put options actually become more valuable as the share price drops, since the ability to sell shares of stock at the put option strike price becomes more profitable. Just like we did with call options, we're going to look at several put option examples so that you can understand how these trades work and what needs to happen in order to make money when trading put options. So let's get started with an example of the IWM, which is the Russell 2000 ETF. This is the option chain for IWM, and let's take a look at the IWM ETF. If you notice that on August 17th, the IWM share price was $197.63. Now let's shift our attention to the September options, which expire in 35 days. I've placed an order to buy a September put option in the IWM with a strike price of $190. So even though the stock price is currently $197.63, I want to purchase a put option with a strike price of $190 that expires on September 21st, which is 35 days from now. As you can see, the bottom middle of the image here, the put option's price is $3.19. But to determine the actual value or premium of this option, we have to multiply that price by the option contract multiplier of 100. This gives us the option's cost value or premium of $319. This is because just like call options, a put option can sell 100 shares of stock at the put strike price. When you buy options, the most you can lose is the premium that you pay for the option, as we briefly discussed in the previous call options section. So why is the put option worth $319 when the stock price is above the put price strike price? This is a good question that we will answer later, but for now, let's keep in mind that a put option gives the buyer the right to sell 100 shares of stock at the put option strike price between now and expiration. Okay. In reality, it may not be smart to buy a put option with a strike price that is lower than the current stock price, as you can simply sell shares of stock at the current price and get more money by using your put option. But there are reasons why put options can still be valuable, even when the stock is higher than the put option strike price. We will explore this more in depth later on. So here is the image of the chart, and you can see that the trend is definitely moving lower, where IWM was over $190 per share. So in this new image, IWM is currently trading at $184.59 per share, which is $13 lower than it was in the first example, and now 22 days to expiration. Looking at the $190 put option in the September expiration cycle in this second image, the IWM's share price is significantly lower. We can see that the $190 put option is trading for $7.94. This means that the option has a premium or value of $794. The put option's value increased because the share price of IWM fell, and since the put options allow you to sell 100 shares of stock at the put option strike price, the put option is now in the money. Since the strike price was $190, the IWM share price dropped from $197.63 to $184.59. Now that this option can provide a benefit to the buyer, if I bought this option a couple days ago for $319 in premium, and now the share price is $184.59, which is way below the strike price of $190, I could use my put option to sell shares of stock at $190, which is immensely valuable because the stock price is well below that at $197.63. And this is true in the case because the share price in this example is $184.59. If I had purchased this option on day one and paid $319 for it, and now it's worth $794, If I sold this put option, I would secure a profit of $475 on an initial cost of $319. If I secure a profit of $475 on an initial cost of $319, my return on that trade is 149%. Looking at the percentage change in IWM shares, they initially traded at $197.63, but then they fell to $184.59, which is a 6.6% decline in the share price of IWM. However, the $190 put option we were looking at experienced a price increase of $149. This means when you buy options, you have leverage.